I just wanted to have a little chat about another situation here. So this is Phil and Mandy's story. Phil's age 65 and is about to retire, and he married Mandy, who's his second wife, about 3 years ago. And Mandy's only age 50. She doesn't want to retire yet. In fact, she's running her own small business, and she's probably going to continue to work for another 5 to 10 years. Now, because Mandy was out of the workforce for quite some years, raising her 3 children from her first marriage, she's got much less in super than Phil. She's only got $500,000 in super, and she's really focused on trying to build up her super over the next few years. Phil's got $1.5 million in super because he's been in the workforce much longer. And when they got married, Mandy actually rolled her super over into Phil's self-managed super fund. So now that now that Phil's about to retire, he's got a couple of concerns. So the first one is, can he and Mandy stay in the same fund if he's going to be in the pension phase and she's going to be still contributing to super? And I guess he's really questioning whether or not it was the right thing for them to do to be in the same fund together, given that they've got very different estate needs in that they both want their own super to go back to their respective children. They've got different risk profiles, so Phil's much more conservative. He likes cash and property. Because Mandy's trying to catch up ground, she prefers shares, so she's been working with a broker for a number of years and much prefers a share portfolio. So he wants to come in and talk about what's the implications now that we're getting to these different stages. So most super funds, when you look at your statements, if you've already got a self-managed super fund, most self-managed funds run pooled assets. So that means while we always keep track of whose money is who within the fund, so we know that Phil's got this much and Mandy's got this much, we're not keeping track of whose assets are whose. The assets are just all pooled in there together. So, and in this case, they were running pooled assets, which just means that there's cash, shares and property in the fund totalling $2 million, but we're not taking any particular notice of who actually belongs to that property or who belongs to the shares or the cash. It's just all pooled in there together. And that is the most common accounting method used with self-managed super funds. Now, because Phil and Mandy have, as I said, very different estate needs, very different risk profiles, one will be in pension, one will be in accumulation phase, it may be better for them to consider running segregated assets. So in this case, it would be looking at the assets of the fund and saying which specific asset suits which member. So in this case, the property really suits Phil better. It was his decision to purchase a property years ago anyway, and he's happy with the high rents on the property. And we would also say the cash probably should belong to Phil as well. Now in this case, that $1.5 million, the property and the cash, is going to be segregated to Phil, and he's now going to be in pension phase, so any income on his side of the ledger will be tax-free, and it will also be tax-free when it comes out to him. And he can then do a binding nomination to say, if I pass away, I actually want the property to go back out to his kids, so he can control that as well. As I said, Mandy's quite happy with the shares, so we would give her the share portfolio, and she would then have to go and set up another bank account within the fund, and that bank account would collect her contributions when she makes them and get all of the share dividends into it, and any trades on the share portfolio would be made through that bank account. So we've segregated it all up on that side. Now, I just said that Phil is in pension phase, so on his side of the ledger the fund is tax-free. On Mandy's side though, any earnings on her share portfolio are still taxable because she's still in the contribution phase within the fund. So if we just have a look at how that works, if we've got a share portfolio, so Mandy's in that 15% tax rate, and she's putting her full $50,000 contribution in every year, and she's getting about a $25,000 cash dividend off that $500,000 share portfolio, all within the fund. Now the share portfolio is very blue chip, so it's fully franked, so all the franking credits that attach with those shares come through. And even though we've got cash income in the fund of $75,000, our taxable income is about $85,000 because of those franking credits. So we pay tax at 15% on our $85,000, so we've got tax of $12,800, but then our franking credits come off that and reduce the tax payable, so we're now left with only $2,000 in tax payable. And that's a pretty great outcome if you consider that the 15% tax just on the $50,000 contribution would be $7,500. We're now not even paying 15% tax in this fund. So it's a great outcome for Mandy when she's still in the accumulation phase. And that's just the power of the franking credits. Now, once Mandy actually retires, this actually gets even better, because then she's got her $25,000 cash contribution plus the franking credit. She's got $35,000 in taxable income, but now that she's in pension phase, all of that income is exempt pension income, so there's no tax to pay on it. And she will get all of the franking credits back. The $10,714 will actually just come back in as a tax refund back into her fund every year. So on a $500,000 share portfolio, that $10,700 is an extra 2-point-something% per annum return that you're getting from the tax office. And after you've had a long period of time in the workforce paying tax, it's very nice to get these big refund checks coming back into your fund in retirement.